Something unusual is happening in the silver market right now, and the numbers behind it are raising serious questions about how the system actually works. At the center of this situation are two figures that don't seem to belong in the same equation: 73.6 million ounces and 384.7 million ounces. Those numbers represent the amount of silver currently registered and available for delivery inside the COMEX vault system compared to the total open interest in silver futures contracts. In other words, they show how much physical silver is ready to be delivered against how many ounces the futures market is currently promising. When analysts place those numbers side by side, the imbalance becomes immediately obvious. Text, coverage ratio, margin frac 73.6, 384.7, naprox, Euro 2019. This calculation suggests that only about 19% of the silver represented by futures contracts could theoretically be delivered using the registered inventory currently sitting inside the exchange vaults. Now, at first glance, this might sound alarming, but the silver market has operated under this type of structure for decades. The futures system was never designed for every contract holder to demand physical delivery at the same time. Most participants simply trade price movements. They buy contracts expecting prices to rise or sell contracts expecting prices to fall. When those contracts approach their delivery period, traders usually close their positions or roll them forward into a future month. The contracts are settled financially, not physically. This process allows the market to maintain enormous trading liquidity while the actual movement of physical silver remains relatively small by comparison. As long as the majority of traders behave this way, the imbalance between paper contracts and physical inventory does not create immediate problems. The system functions smoothly, but every so often the numbers attract attention because they highlight the fact that the silver market operates on a kind of fractional structure where paper claims on metal greatly exceed the metal that is immediately available for delivery. And when investors begin focusing on that imbalance, the conversation inevitably shifts toward a different question. What would happen if a larger number of traders suddenly decided they wanted the metal instead of the contract? To understand why this question matters, we have to look at how open interest actually works inside the silver market. Open interest represents the total number of outstanding futures contracts that have not yet been closed or settled. Each silver futures contract represents 5,000 ounces of metal. So when the market reports open interest equivalent to hundreds of millions of ounces, it does not mean that hundreds of millions of ounces of silver are moving around physically. It means that traders are holding contracts representing that amount of exposure. These contracts can be created and closed quickly as traders enter and exit positions. The total open interest fluctuates constantly depending on market activity, but the physical inventory sitting inside exchange vaults changes much more slowly. Silver must be mined, refined, transported, and stored. The supply chain operates on a timeline measured in months or years, not seconds. This difference between the speed of financial markets and the pace of physical production is one of the defining characteristics of commodity trading. It works efficiently most of the time. Yet it also creates moments when the financial representation of a commodity becomes disconnected from the physical material itself. The current numbers in the silver market are drawing attention precisely because they appear unusually stretched. When analysts see open interest representing nearly 385 million ounces of silver, while only about 73.6 million ounces are registered for delivery, they begin asking whether the system could face pressure if physical demand increases. Again, under normal conditions, there is no immediate issue. But the silver market today is not operating in completely normal conditions. Demand for silver has been rising steadily due to its role in modern technology. Solar energy infrastructure uses significant amounts of silver in photovoltaic cells. Electric vehicles rely on silver in electrical systems. Advanced electronics, medical equipment, and telecommunications hardware all require silver for its unmatched conductivity. At the same time, the mining industry has struggled to significantly increase production. Many silver mines are aging, ore grades are declining, and developing new mining projects can take more than a decade from discovery to full production. This means supply growth tends to lag behind demand growth. For years, the market has balanced itself through recycling, above-ground inventories, and the financial trading system that helps smooth price fluctuations. But when the numbers inside the futures market begin stretching far beyond the physical metal available in vaults, the situation starts attracting attention from both investors and analysts, because those numbers highlight a simple reality. The futures market represents claims on silver. The vaults represent the metal itself. And the relationship between those two layers of the market depends heavily on confidence. As long as traders believe the system functions smoothly, Most participants are comfortable trading contracts instead of taking delivery. But if confidence ever shifts, if more participants begin wanting physical metal rather than paper exposure, the balance between those layers can change quickly. That is why the current silver math is attracting so much discussion. Not because the numbers guarantee a crisis, but because they reveal a structure that depends on certain assumptions continuing to hold true. And when the difference between paper claims and physical supply grows large enough, those assumptions eventually come under scrutiny. Which brings us to the next critical piece of the puzzle. How does the futures market actually interact with the physical silver supply sitting inside exchange vaults? To understand why the current silver numbers are attracting so much attention, we need to look more closely at how the COMEX vault system actually works, because not all silver stored in exchange vaults is available for delivery. This is where many investors misunderstand the structure of the market. Inside the COMEX system, silver inventories are divided into two primary categories: registered silver and eligible silver. Registered silver is the metal that has been specifically designated for delivery against futures contracts. It meets the exchange's standards for purity, weight, and storage, and most importantly, it has been officially committed to the delivery process. If a trader holding a futures contract chooses to stand for delivery, this registered silver is the metal that can be transferred to them. Eligible silver, on the other hand, is also stored in COMEX-approved vaults but belongs to private owners who have not committed it to the delivery system. These owners may be investors, financial institutions, or industrial users storing metal for their own purposes. Although eligible silver meets the physical standards required by the exchange, it cannot automatically be used to settle futures contracts. It would first need to be converted into registered status, and that conversion requires the consent of the owner. This distinction is critical when analysts evaluate the silver market, because when the exchange reports that approximately 73.6 million ounces of silver are registered, it means that this is the amount immediately available for contract delivery. The rest of the metal in the vault system may technically exist, but it is not guaranteed to be available if delivery demand increases. This is why open interest numbers often attract attention. When traders see futures contracts representing 384.7 million ounces of silver, while only 73.6 million ounces are registered for delivery, they begin comparing those numbers. The gap between them raises a simple question. If a large number of contract holders suddenly decided they wanted physical metal instead of rolling their contracts forward, how easily could the exchange meet that demand? Under normal conditions, the answer is straightforward. Most traders do not take delivery. In fact, the overwhelming majority of futures contracts are settled financially before they reach the delivery stage. Participants close their positions or roll them into the next contract month. Delivery typically involves only a small percentage of total contracts. This is how the system has operated for decades, but every futures market has specific months where delivery activity becomes more concentrated. These are known as delivery months, and for silver, certain months, including May, July, September, and December, tend to attract more attention. During these periods, traders holding contracts must make a decision. They can close their position, roll it forward, or stand for delivery. Standing for delivery means the trader intends to receive the physical metal associated with the contract. This process triggers the transfer of registered silver from the vault system to the contract holder. When delivery demand remains relatively small, the system functions smoothly. Registered inventories decline slightly, metal changes hands, and the market continues operating normally. But when analysts see open interest levels that appear unusually large relative to registered inventories, they begin watching delivery months more closely, because those months reveal whether traders intend to continue settling contracts financially or whether they are increasingly interested in the physical metal itself. If delivery demand remains modest, the imbalance between paper contracts and physical silver remains largely theoretical. But if delivery demand rises significantly while registered inventories remain limited, the relationship between futures trading and physical supply can become more sensitive. This is why market observers often refer to situations like the current one as a potential perfect storm. Not because the imbalance automatically triggers a crisis, but because the conditions for stress begin appearing in the system. Several forces are already interacting inside the silver market. Industrial demand continues expanding due to renewable energy infrastructure, electric vehicles, and advanced electronics manufacturing. Investment demand periodically increases when investors seek protection against inflation, currency volatility, or geopolitical uncertainty. Meanwhile, mine production growth has remained relatively slow due to declining ore grades and the long development timelines required to bring new mining projects online. These structural forces shape the physical silver market. But the futures market operates much faster. Traders can create or close contracts instantly, generating enormous volumes of paper exposure relative to the underlying metal. Most of the time, that financial layer helps stabilize the market. Yet when the ratio between paper claims and physical inventories becomes unusually large, analysts begin examining whether the balance could shift if demand patterns change. This is exactly what the current numbers are highlighting. The 73.6 million ounces of registered silver represent the metal immediately available to meet delivery obligations. The 384.7 million ounces of open interest represent the total contractual exposure circulating through the futures market. Under normal circumstances, only a small portion of that exposure converts into physical demand. But when market participants begin noticing the gap between those two figures, the conversation often turns toward the possibility of a squeeze. Not because a squeeze is guaranteed, but because the structure of the system makes one theoretically possible if several pressures begin interacting at the same time. And that leads to the most important question investors are asking right now. What would actually trigger a silver squeeze in a market structured like this? To understand why the current silver numbers are raising eyebrows across the market, we need to go one layer deeper into how the silver market is structured. Because the silver market does not operate like a typical commodity market where price discovery is driven primarily by the physical exchange of goods. Instead, silver operates inside a hybrid system made up of two separate but interconnected markets. The first is the physical silver market. This is where real metal moves through the supply chain. Mines extract silver from the earth. Refineries process the ore into bars or industrial forms. Manufacturers purchase silver to produce electronics, solar panels, medical devices, and a wide range of modern technologies. Investors also participate in the physical market by purchasing coins and bullion that can be stored privately or inside vault systems. This side of the market moves slowly. Mining projects take years to develop. Industrial demand evolves over long production cycles. Supply chains respond gradually to changes in economic conditions. The second layer of the silver market is the paper market. This is where futures contracts, options, and derivatives tied to silver are traded by financial participants. These instruments allow traders to speculate on price movements without owning the underlying metal. Futures markets exist to provide liquidity and help producers and consumers manage price risk. But over time, financial trading has grown so large that it now dominates daily price discovery. On many trading days, the volume of silver contracts traded on exchanges can represent hundreds of millions of ounces of exposure changing hands within hours. Yet the amount of silver physically moving through the supply chain remains far smaller. This difference between financial exposure and physical metal is what leads analysts to describe the silver market as operating on a fractional system. There can be many claims on silver for every ounce that actually exists inside exchange vaults. Estimates vary depending on how analysts measure exposure, but some studies have suggested that the ratio between paper claims and physical metal can reach extremely high levels. This does not mean the system is fraudulent or broken. It simply reflects how financial markets function. Most participants trading futures contracts have no interest in receiving or delivering metal. They are speculating on price movements, hedging risk, or managing portfolio exposure. As long as traders remain comfortable settling contracts financially rather than physically, the system functions smoothly. But this structure also introduces an interesting dynamic. Because the price of silver is determined primarily by activity in the paper market, short-term price movements can sometimes diverge from the underlying fundamentals of the physical market. If financial traders become heavily bearish, they can sell large numbers of futures contracts, pushing prices downward even if physical demand remains stable or rising. Conversely, speculative buying can push prices higher even when physical supply is abundant. This layer of financial trading can temporarily obscure what is happening beneath the surface, but it cannot eliminate the influence of physical supply and demand forever. Over time, the physical market always reasserts itself. When supply becomes constrained or demand increases significantly, the financial market must eventually adjust to reflect that reality. This adjustment is often where squeezes occur. A squeeze happens when participants holding short positions in the futures market suddenly face pressure to exit those positions. Short sellers borrow exposure to silver by selling contracts they do not own, hoping to buy them back later at a lower price. If prices rise instead of falling, short sellers begin losing money. Because futures markets operate with leverage, those losses can accumulate quickly. At some point, short sellers may decide, or be forced by margin requirements, to close their positions by buying back contracts. When many short sellers attempt to exit simultaneously, their buying activity pushes prices higher. This creates a feedback loop. Higher prices force more short sellers to exit, which pushes prices even higher. In markets where leverage is high and physical supply is limited, these squeezes can unfold rapidly. The silver market has experienced several notable squeezes throughout history. One of the most famous occurred in 1980 when the Hunt brothers attempted to corner the silver market by accumulating large amounts of physical metal and futures contracts. Prices surged dramatically before the exchange intervened with rule changes and margin adjustments that ultimately reversed the move. More recently, episodes of heightened retail interest in silver have also demonstrated how quickly attention can shift toward the physical supply side of the market. Each time this happens, analysts begin examining the same set of numbers: open interest, vault inventories, delivery demand. When open interest appears extremely large relative to the physical silver available for delivery, the potential for market stress increases. Again, this does not guarantee that a squeeze will occur, but it creates conditions where one becomes possible. This is why the current numbers, 73.6 million ounces registered against 384.7 million ounces of open interest, are attracting attention. They illustrate how much larger the financial representation of silver has become compared to the metal immediately available to settle contracts. As long as most traders continue rolling contracts forward, the system remains stable. But if market behavior changes, if more participants begin requesting physical metal, or if short sellers face pressure from rising prices, the balance inside the system could shift quickly. And when that shift happens, the silver market can move much faster than many investors expect. Which brings us to the final question. If the current numbers represent a potential perfect storm, what would actually trigger the moment when the silver math finally breaks? So what would actually cause the silver math to break? Because the numbers alone do not trigger a crisis. The imbalance between paper claims and physical metal has existed in the silver market for years. The system functions as long as most participants continue behaving the way the system expects them to behave. That means traders roll their contracts forward instead of taking delivery. Industrial users source metal through normal supply channels. Investors remain comfortable holding paper exposure rather than demanding physical silver. But a perfect storm occurs when those assumptions begin to change. The first trigger would be a sustained increase in physical demand. If industrial buyers, investors, or institutions begin pulling more silver out of the supply chain than usual, registered inventories inside the exchange system could start declining faster. The second trigger would be a rise in delivery requests during major contract months like May. If a larger portion of contract holders decide they want the actual metal rather than financial settlement, the exchange must source that metal from registered inventories. And the third trigger would involve market positioning. If a large number of traders are holding short positions while prices begin rising, those traders may face pressure to close their positions quickly. Their buying activity can accelerate the move upward, especially if liquidity in the futures market tightens. When these forces interact, rising demand, limited inventories, and leveraged short positions, the silver market can shift from stability to volatility very quickly. That is why analysts are paying close attention to the current numbers, because they reveal a market where the financial representation of silver is far larger than the metal immediately available to settle contracts. Most of the time, that imbalance remains invisible. But when conditions align, it can become the spark that forces the market to confront the underlying math. And when that happens, silver rarely moves slowly.